Okay, so let's go ahead. So hello everyone, welcome to our new EDHEC virtual speaker service session on the future of finance. So I'm Emmanuel Josenko, I'm the director of the graduate finance program here at EDHEC, and it's my pleasure in fact to welcome you today. So as usual, you can use the Q&A chat box in fact to ask a question. We will pass that to Ludo after his presentation. We will post also the slides, and the recorded video will be on our dedicated webpage. Okay, so all right, let's move to the program. So first I want to introduce our two co-moderators. First I'm pleased today to have Hamid Boustanifa, which is a corporate finance expert at EDHEC. And I'm also pleased, in fact, to have Mathis Lopez. So Mathis Lopez is a student from our corporate finance MBC program. And it's my great pleasure to have today Professor Ludovic Phalippou. So Ludo, well, will be able, in fact, I think there is a slide in your presentation where you will be able to introduce yourself better than I, but I just want to mention that Ludo is an expert in private equity. It's more than 20 years that he worked on private equity, private markets. His research is regularly, extensively cited in the press in academia. Thanks to Ludo, now we know how to use internal rate of return. We know a lot of stuff with respect to how not to be manipulated with respect to performance in private markets. What is important is to know that Ludo, beside all his research, is also a wine enthusiast and is a bike addict. And Ludo is French, nobody is perfect. So Ludo, we are very fortunate to have you today. Really a big thank you. And now the floor is yours. Thank you, Ludo. Thank you for your time and for sharing your expertise on the private markets. Question, will private markets kill us all? We will see that. Thank you, Ludo.
Thank you, Emmanuel, for having me. So let me share the slides which I prepared, just to tell you that the title of the talk is not going to be the content of the talk. We flip-flopped about it. And so I decided to talk about a recent research project that was very applied and probably more interesting for the audience here. But I'm happy to answer any questions about private equity. Like Emmanuel said, I found nothing better to do with my life over the last 22 years than doing research on private equity. That's all I've done. I've been eating private equity for breakfast, lunch, and dinner every single day of the year. So, you know, if you have any questions, feel free. Doesn't really matter, but that's me. You can also follow me on social media. I have a website with all kinds of resources. I have a book. I have a podcast series, etc., etc. So basically, when we say when we talk about private equity, private markets, etc., what we're talking about are these funds that intermediate money privately. So these private market funds are usually set up as limited partnerships, and the well-known managers are firms like Blackstone, KKR, Carlyle, Permira, and so on and so forth. And over the years, they have accumulated a lot of money. So when I started, working on private equity, it's the beginning of this chart on the left-hand side. The data starts at that date because basically at the time there was hardly any data. And I started working on this topic because I was one of the first academics to see private equity data. And already at the time we were saying, oh, you should pay attention to private equity because it's quite big. It's like it's nearly 1 trillion. Okay, so we were saying, it's a big deal. And then if you look at the evolution of the amount of money managed by these funds, it just went exponentially, right? So it's still right above 1 trillion, like in 2004 when I graduate. It jumps a bit 2005, 6, and 7, and then we're saying, oh my God, and everybody was talking about private equity, and my research on private equity became circulated quite a lot because there was so much money going into private equity in 05 or 6 or 7. I was doing research on other things, but that was then getting a lot of attention because they were booming these markets. But yet we were just barely at 2 trillion in 2006. Then during the financial crisis, it just stays flat, basically. And after that, it's just and it skyrockets, continues to grow very fast until 16. And then 17, 18, 19 just like goes through the roof. And the two bars, the last two bars, they are close to one another just because one is March and 2020 and the other one was December 2019. I didn't bother update this slide, but if I had put it to December 2021, you see it's 8 trillion in 2019, in 2021 December. So the last data we have is at over $10 trillion. So imagine a bar at 10 trillion and you will see how exponential it has been, especially over the last 3-4 years. So certainly now everybody is aware that private markets and private equity is a big deal. And there's lots of money in there and they influence quite a lot of companies and lots of things. To give you an idea of what 10 trillion is, so you know Euronext, which is not just Paris, it's Paris, Amsterdam, and a few others. Euronext altogether is 5 trillion. The London Stock Exchange is a bit less than 4. And the Deutsche Börse, so the German stock market, is 2 trillion. So basically, you would need to add up basically all the stock exchanges in Europe, and you will have a size of world private markets funds, AUM. So it's a pretty big deal. So I'm not going to go through that graph so much because, as I said, I'm going to focus on one recent research project, and I want to give time for Q&As because I think it will be more interesting. But I'm happy to go back to there. This is what makes private equity different from the normal setup in terms of governance of companies, and also about the fee deals they have with investors and so on. So that there are some things that are unique about private equity, and that generates a number of big questions, like, you know, the money of private equity firms comes from someone else, is other people's money, but these people are in control. And so usually in finance, we are quite worried when somebody's in control with other people's money, because there is all kinds of conflicts of interest, which we study and document in corporate finance. Other big questions out there is like, what is the pros and cons of having a private equity managed company versus a publicly listed one, since there is less and less publicly listed companies and more private equity ones. We worry a lot about stakeholders in private equity context. We worry a lot about employees and the like. And the reason for that is that private equity firms are very, very profit focused. And we are a bit afraid that when somebody is very profit focused, they may not care too much about the externalities that they have on employees, environment, and so on. And we are also interested, about this I was, in LPs payment for this financial intermediation, how expensive it is, and how much return do they get, how much volatility really is out there, etc., and debunking a few myths around the risk-return profile of private equity. I have written this book, which is doing okay. It's available on Amazon. It has the feature of being very cheap compared to other private equity books. So I think in France, it's at 25 euros, if not less. And it's even available on hard copy, and it covers everything about private equity. It covers the fund sides of things. It covers these questions about the impact on society and impact investing, etc. And it covers all the issues about limited partners and the fee structures and so on and so forth. So this project I wanted to talk to you about is about trying to find something to replicate private equity returns in the public market. So I've been working on that for 15 years. Lots of banks have always been very interested in developing such products. And I've worked with a number of banks over the years trying to do that. And we never really found like a good traction. It was a very hard sell. But this one project here, which to be transparent, was developed with and at JP Morgan. And I helped JP Morgan developing this product, and I think it's quite innovative and pretty cool. But we may decline it in different versions with some other people. But this product is actually already live on Bloomberg for a year, and we developed it 3 years ago. There was a 2 years embargo on the research, and so now the paper is available. And so why would we want to have something that replicates private equity returns? And we are focusing on buyout returns here. So we want that because sometimes institutional investors want to have a readily accessible solution to hedge. So for example, if they are afraid that they are over allocated to private equity and a bit too exposed to private equity, they want something that they could quickly short, for example, to reduce their exposure to private equity. Vice versa, if they are underinvested in private equity and they want to quickly, get to their optimal allocation, they may want to use a quick solution. So this idea of quickly altering exposures, and also currently, because people are never, you need to commit, and then people call only the money over time, there is this strategy that's called overcommitting. You basically say, I want to commit 200 to private equity when you want to invest only 100. And that presents some risk, that because you said, like, I want to spend 200 million on this, but what you want is to have at any point in time 100 million. But it could happen that you suddenly get 200 million deployed in there, and then the rest of your holdings go down in value, and you are very overexposed to private equity. So the institutional investors may want this kind of products, and also high net worth individuals may find that it is easier to access private equity via a public listed vehicle, because then you avoid the high fees, it's more transparent, and so on and so forth. But what is, I can tell you a bit about the existing solutions, but what is most interesting is how we go about it rather than why people may be interested. I think it's interesting per se what we did. So, and the reason this is interesting, and that's why I thought it would be cool for students in the master level, is that it's not just for private equity, but it's index in general. So there are all kinds of indices out there. There's actually more indices than there are stocks. So you will have indices on like the leisure industry. You would have an index on green transition. You would have indices on absolutely everything. And the way people build these indices is that they have some analyst that looks at all these stocks one by one and say, is this like green transition, yes or no? And then, and say, okay, this one is a yes, this one is a no. So it's a binary decision. And once they have all the stocks that they say, okay, they are, these are like green transition stocks, then they say, okay, then we take the market cap of the stock, and then this is what we use as a weight, and that's it, that's our index. Okay. So it's a very ad hoc way of coming up with weights of different companies, right? So it's a binary decision, 0, 1. And so if you have a big company that was marginally green transition, and you decided it was green transition, and then it's a big company, then suddenly it's in this index with a massive weight because it's a large company, and it was even a marginal decision whether it should be included or not in green transition. So it's how all the indices are constructed, and it's a bit weird and unintuitive, really. Some other people also try to do factor analysis. So they say, oh, okay, so if it's green transition, it loads on this and that factor. So I'm going to make an index with different factors, and that will give me the exposure. The bottom line is, it's not so interesting. What others are doing is not very good. And so here is what I think is the cool stuff. And let me tell you then about what we did. The idea is that instead of saying this company is a yes or a no for green transition or for private equity, whatever you want to do, the idea is to say, how much is this company exposed to the thing I want to capture? So imagine I would like to capture private equity firms that care about ESG. Then the idea would be different people will have different degrees of how much they care. So Emmanuel may care a little bit more than me, and Enrique may care 0, right? So we would have different degrees of caring about that. Then the question is, how do you find out how much Emmanuel cares about ESG, and then how much private equity does in life? So you could say, well, I'm going to go on the website of Emmanuel and the one of Ludo, etc., and I'm going to look for what they say on the website. Well, maybe I have a very small website. Emmanuel has a big website, and so the words private equity will be there 10 times on the Emmanuel website because he has a big one, and I have just a small website. I hardly write anything, and so I'm not there. You could look in disclosures of companies, etc. It has all kinds of limitations. We felt that the most accurate way available to know whether somebody is doing something is to study press release. Because nowadays, any company whatever they do, they just issue a press release. Okay, so if I decide to invest in whatever, I put a press release. If I acquire the company doing whatever, I put a press release. If I'm celebrating my earnings and that I have acquired some new clients, I will issue a press release, and so on and so forth. And we have softwares and databases of all the press releases in the world. So it started basically in 2006 to numericize all the press release. And by now, I think we're like 10 million press release. And so you have all these 10 million press release about 30,000 different companies that are publicly listed. And then you can study whether people, what is it they say? You know, if somebody is always talking about private equity in the press release, it's probably they are doing quite a lot of private equity. If somebody is saying in 1 in 10 that they are doing private equity, well, they're not doing that much private equity, right? So think about Partners Group in Switzerland. In basically nearly every single press release, they will talk about private equity because that's all they do. If you think about the Blackstone, they're not actually going to talk about private equity in all their press release because they do a lot of real estate, hedge funds, all kinds of other things. And so Blackstone will talk about private equity in about half, 2/3 of a press release, but not all of them. And if you take a BlackRock does quite a large amount, has quite a large amount of money in private equity. They have like 30 billion, but it's a 7 trillion company. Private equity is a small part of BlackRock. So if you look at BlackRock press release, private equity is there often because they do quite a lot, but out of all the press release of BlackRock, 10% is private equity. And so that gives you like how much a company is exposed to a given industry, how much do they do of something. And you can add like an ESG component by saying, I want both private equity and ESG, and so on and so forth. So basically, in a nutshell, we wanted a portfolio of stocks that captures private equity. And the way we did that then is, like I described, this is some more reasons for why other ways are pretty poor. And we went for analyzing the text of news of companies. And we searched for words like leverage buyout and private equity. So the advantage of having a portfolio of stocks that are private, that are capturing private equity or that do private equity is that it is cost effective. So if you're just trading a portfolio of stocks, it's usually pretty cheap. And you can also, and that's very important, quickly add new entrants and people exiting, etc. So for example, there has been a lot of mergers recently or M&A activities whereby a financial institution that was not doing any private equity has suddenly bought a company. So for example, Landmark, which does only like secondary private equity, was bought by a bigger company that was not doing any private equity. And they bought Landmark because they wanted to have a private equity division. So that company that didn't have any private equity, suddenly now they're going to be doing quite a bit of private equity, and there's going to be a press release with the word private equity with their name. And our index is going to pick that up immediately. You don't need to wait for the next meeting of analysts to go through all the M&As and say, oh yeah, this company, yeah, they used not to be private equity, but now they bought Landmark, and Landmark's pretty big. Let me check how big Landmark is in terms of revenue share to this company. Or maybe should I use revenue share, or maybe I should use profit shares? And you go on, and then you're late, you don't know what to do anyway. And with press releases, then it's easier. As soon as these guys start like buying PE businesses, then they show up in private equity related news, and your index picks that up. So it's actually quite precise. It's also very flexible, because if you wanted to capture, you know, some like let's say some Chinese companies, you could add like a Chinese name for private equity. You can add words like venture capital in case you don't want just private equity leverage buyout, but you're also happy with venture capital, etc. And we had also all kinds of innovations on the way we dynamically trade this portfolio so that it's liquidity efficient. And I'm happy to explain that if you're interested. So this is the news articles, what I was mentioning. The company is called Ravenpack, and they have digitalized these articles, but they have done more than digitalizing articles. What they've done, which is really cool, is that they have tagged everything and they tell you where these things are in the article. So for example, imagine that Emmanuel is showing up in a number of articles that are private equity, but he's always in like paragraph 4 or 5 in the press release. So probably Emmanuel is an advisor or like someone who's like vaguely related to that news. And so then we're not going to put a lot of weight on Emmanuel being in the news about private equity because he was very low in the article where I mentioned him. But if he's mentioned in the title of a press release, and we have Emmanuel and private equity in the title, then it's a big deal. Like Emmanuel is really doing private equity, is there in the title with the name private equity. So Ravenpack would have this weight as a function of where someone is mentioned in an article in relation to the keywords we are looking after. So this is really, really powerful. And again, you can do that with all kinds of things. You can do it with climate change. You can do it with anything you want. So there are things to be careful about and how to like optimize with portfolio constraints, etc. It's actually a very cool mathematical problem. And we ended up with this index and we didn't even constrain the weights or anything. And we ended up with lots of names, everybody with a reasonable weight. Again, even though we didn't put a cap on weights, and the ranking is making sense. You see, for example, KKR has a lower market cap than Blackstone. In the standard index, Blackstone has a higher weight than KKR because Blackstone has a bigger market cap. But here, KKR has more weight. Why is that? Because KKR does almost only private equity, while Blackstone does all kinds of other things. And this is how you end up with this weight that actually makes complete sense. And there were some names that at first I was surprised by, like, for example, Houlihan Lokey, which is like an investment bank. And I was like, is that a mistake? Why is this investment bank showing up in my number 16? Okay. And then you read about that, and then you realize that this Houlihan Lokey is actually a placement agent. They advise on PE restructuring and sell-side advisory work for mid-cap companies. So it is an investment bank, but this investment bank is doing only private equity. And this is how, in a normal index, you won't find an investment bank in the index. But you should have an investment bank like this one because all it does is private equity. Sunny is a fund administrator in Luxembourg. Same thing, they only do private equity, and that software picked it up. I wouldn't have picked it up by hand, and I think not a single private equity listed index has it in its index. And the index did extremely well. That was not the goal, but the performance are extremely high. The last year, actually, it's up 80%. It has been extremely strong, and because we are more diversified as well, because we go to add investment banks, fund administrators, and the like, we have lower volatility. So I just wanted to give you a sense of all these topics. I zoomed in a bit on a recent research project, just so that you can get a sense of, like one particular project I was working on. But like I said at the beginning, do take advantage to ask any questions that you're interested in, and let's do that as a Q&A. But I believe first it goes to Hamid, right, Emmanuel?
Yeah. So thank you very much, Ludo. So now I will let Hamid followed by Mathis. And as Ludo said, for all the participants, do not hesitate to send questions in the Q&A so that we can pass it to Ludo. Hamid?
Okay, thank you very much, Ludo, for this great presentation and showing us the power of textual analysis. In fact, I am a big fan of these types of work, and I wish actually I had the pleasure of reading this kind of simple but very powerful and sort of applied work more within finance. So anyways, today I had the pleasure of reading this. I was not aware of this paper, although it's been around at least for some time apparently. And it turns out that I have been doing independently very similar stuff, which I thought actually now to show some of the things I have done also with a different data set, and then from that I try to ask a few questions to see how we can kind of merge these things together in a way. So I am not a presenter, but I can try to actually share my screen, and let me know if you see the graph. Yeah, okay.
Yeah, we can see it.
So some time ago, I was thinking about the same sort of idea that how can we look at the, can we come up with a sort of an index that we picks up the private equity and developments of it. Super simple. So instead of going to press releases, I went to the annual filings in the UK and in the US, sorry, and I just get the count of private equity and private markets. And I tried actually venture capital also, but it doesn't change a big thing. So I'm just showing you here private equity, private markets. And here, I just did a simple on the blue line. I did a simple counts, the average counts that I saw since this is the data since the mid 90s, where the public listed companies, they were filing electronically. And you see also the increase in here, and the red lines showing you the number of the firms that this shows up as reporting at least more than 10 counts of private equity, private markets in their filings. And then I tried to do a similar sort of analysis by looking at what happens, what are the top companies in the list that shows up. So here's in 2020, of course, each year could change a little bit. And I see, some usual names in here. See this KKR showing up relatively high, and some bunch of other names in here. And then I see also exactly 2020, there's a one new name, because if I look at 2019, this is the 2019 data. This stepstone is not there. 2020, it's there. Seems that a new entrant we have in the market. So this is also seems to be quite reactive in a way, what Ludo was saying. And so the question is that how can we compare these two sort of analysis that we get, this sort of resource that we get, which ones a priori it's more reliable. So one thing I was thinking about the press release is quite nice, because it's not something that the company itself is revealing. It's like unlike the annual filings. So that's why I think if you want to look at the things like, let's say, corporate social responsibility, you have no hope of going to the company's filings, because everyone is good. So everyone is going to say that I am good, I don't pollute, I don't do this and that, but going to the press release, it's maybe much more reliable. When you go to the business of the firms, let's say, what kind of business overall they are involved in, I just want to raise this question that I am not 100% sure, for example, going to the press release necessarily is a best idea, because at least one could think that, if I am involved in, let's say, private equity, but I do some more controversial things that, people don't like and get a lot of press coverage, then I'm going to show up a lot on the private equity side, but, it's just more controversial aspect of it. So is that something that, Ludo, you are concerned about, that the news may not be reflecting really the business of the firm, and be more focused and biased towards the more, let's say, controversial aspects? I don't know whether in private equity per se it's going to be a big deal, but at least one could think of it in other dimensions that could be biased, right, towards specific actions.
Yeah, so I think that there are some industries or keywords that wouldn't work. So I think one needs to be very careful about that. So in private equity and buyout, you can see it from the firms that are being generated. That's really not an issue. There is no one out there that spends their life criticizing private equity, but does not do any. So you could think an example, the best example of what you would say is like Warren Buffett is usually not very impressed with private equity. And so you could have Warren Buffett in the news always with his firm Berkshire Hathaway saying, oh, private equity guys are all cheating and it's all terrible, etc. And I would never do that. But the odds that one press release in 3 or 1 in 2 from Berkshire Hathaway would be about him saying, I will never do private equity is pretty small. So if you would pick up, people would just have like 1 or 2% of a press release in private equity, but here the filter we have even is at 25% of 1/3. So the chances here are very little, but it depends on the sectors and what you want to capture. So recently someone was looking at, can we do this for like religious indices where you look at scenes and things like that. If you list the scenes, it would be quite difficult to program to make sure you take the people that do not sin versus the people who spend their time sinning. So because the words will be there a lot in the press release. So either it requires more advanced language to find the negatives and things like that around the word, or about just, I think it's safer to say that there are just some sectors that are more difficult to capture. So if you wanted to capture, for example, real estate, and said, I want an alternative to the REITs. I don't want to go with REITs. I just want to know people involved in real estate. If you use real estate, you can have all kinds of reasons. Somebody mentions real estate repeatedly in the press release, not necessarily because they're in the business of real estate. So real estate would be an example of something very difficult. Another one that is even more difficult is infrastructure, because people use that word for different contexts. And so if you wanted to capture infrastructure investing that way, that would be very tricky. I think with leveraged buyout and private equity, you're in safe hand. And then when you see the firms that are generated by the algorithm, it makes complete sense. So like I said, there are some firms I didn't know, and then you check what they do, and it's like, the advantage is that you can always check, right? So you have these firms you don't expect, and then you get the press release that mentions the words, and you can see whether these press releases are indeed, things they have done that are in the business or not. It's working well, but yeah.
Exactly. So that's the first kind of filter that, out of 40,000 companies gives you, like 50 companies, then you can take a look and see which.
Because if you do the 10K, like you were saying, like you have some people who describe, imagine you have BlackRock. I mean, BlackRock doesn't write it this way, but BlackRock could very well spend a lot of part in their 10K filings explaining at the risk of business that the big risk of their business is that private equity grows, and then the ETFs are dying because there is not enough publicly listed firms. And so private equity is a big threat to them, and so on and so forth. And so they explain that private equity is a threat and so on. And then you say, oh my God, like BlackRock is mentioning private equity all over the place. But if you buy that stock, it's the opposite. They say they are threatened by private equity. In the press release, it's not going to happen. Somebody's not going to issue press releases to say I'm threatened by X, and they issue press releases to say what they do.
Okay, thank you very much. So I hand it over to Mathis to continue. Maybe we come back again with some questions later on. Thank you very much.
Okay, thank you, Hamid. Thank you, Ludo, for the presentation. I have a question regarding the algorithm also. What I mean and what I want to ask, if companies decide to increase their media coverage with press release, how will the algorithm react to them? What I mean is that how will you differentiate good companies in terms of press release and good companies in terms of returns?
So we're not after returns. We just want to know who's in the business of private equity. So we're not trying to filter out the winners or the losers or things like that. And about the companies increasing media coverage or media presence, we take the fraction of articles that are mentioning private equity out of all articles that are about them. This is how you have a BlackRock has in absolute numbers lots of articles that mention private equity and BlackRock, but in proportion of all their articles, it's peanuts. So they're not in. So it's all proportional. So if BlackRock just decides to increase media coverage, you can only be toast if you have a firm that says we're going to increase media coverage, but only to talk about our private equity for no reason. Like business-wise, it doesn't make any difference. We're just going to talk more about our private equity division. Why would you do that if it's not to boost your private equity business and because you want to expand it, or why would you do that? So the total number of articles, that doesn't influence the score.
Okay, understood. And I have a more general question regarding return computation in private equity. So we know that there is some flaws by using IRR. Do you believe that LPs will try to convince GPs to have a new method? For example, we know about modified IRR in Excel. Do you have any thoughts about that?
So I've been saying this for 20 years and nobody has ever changed anything. So I know by now that nothing will change. Unless the SEC imposes it or something like that, but I don't think it will change.
Perhaps I think if I may jump, obviously this is something which is super interesting because you don't have only dumb people, right? In this industry, you have a lot of smart people, and Ludo effectively is the one that really makes sure that people understand, in fact, how you can game those metrics. So it's still a bit strange to see that that big investor, you know, they are not going. That mean at least to multiples, right? Which would give you a better view.
So the smarter one, they may mention multiples, but if you take, there's also, I mean, one needs to not forget that people are conflicted. So if you take probably the guy who was the most knowledgeable about private equity is David Swensen. You take David Swensen, you take the annual report of Yale Endowment, it was only IR being reported. And so after a while, and me putting the pressure on this, saying, you know, Yale is a hero because of a number that is in the annual report every year, but it's always the same number, and that's because it's an IR, and it's a completely stupid number. And then after a lot of pressure, he confessed that indeed it was an IR, and then he said, but we use other metrics. We use also multiple and PMEs and all these things. And the question was, why don't you put that in your annual report then? You're using them. You say you acknowledge that this is a fraud metric and there are some better metrics and you are using them. You're just telling me you're using them. Why they're not in your annual report? And the reason is because they're not as impressive. A 30% return is outstanding. You say, you know, Yale has done 30% in private equity over 30 years. Seriously? It's amazing. That's impressive. If you say, what is the multiple of Yale? If I had to guess, probably 1.5, 1.6 times the money. Is that impressive? Well, that's what the stock market gives you over a 5 years period. So it probably is good, but you know, it's not something to like write home about. A 30% return is something to write home about over a long time period.
So people people like to dream.
Yeah, and then but you also have, you know, David Swensen was paid $5 million a year, right? Because he was a hero and because he had this reputation. You cannot, you know, you should not forget all the different layers of conflicts that people are facing. The private equity division of CalPERS, they are happy to report a good IR because the board doesn't get it anyway. So they know, but you know, it's cool to have a measure that exaggerates things because they can go to their board and see we are geniuses. We need to hire more people and to be paid more. That's it. So you know, we have a bit this issue with like people are saying, oh, they're sophisticated, so it must be good, and so you must be wrong because these people are smart. So you know, it cannot be bad. It's people forget the multi layers of conflicts of interest that people are facing. So that's the main reason. The other reason also is that we don't have a good replacement. So even the modified IR is imperfect. And so the truth is that we do not have a perfect measure to replace IR. We may devise it. It's something I'm working a bit on now because I've been pushed hard. For many years, I just said, just forget about the rate of return. Just use a PME, use an NPV, like you're told in corporate finance. Okay, just use net present value. Don't use IR. And with an NPV, you have something to be careful about, but you'll be okay. But I think that people cannot live without a rate of return. They are used to it so much. They want to know annualized. What are we talking about? If I say, you know, you have an NPV of 1 million, like I don't know what that means. I don't know if it's a lot. I don't know if it's not a lot. Tell me in percentage per year. And the problem is that annualized returns, rate of returns, are defined only for continuously traded assets. And so then in private equity, they're just not defined. So we don't have a solution. And so IR is a stupid solution, but we don't have a perfect solution because there is no solution. So there is one that I'm thinking about and I may propose, but I'm quite pessimistic about the odds of people adopting it. So the bottom line is that we do not. It is impossible to talk about rates of returns for something that's not publicly continuously traded. That's it. But people are so used to it, and it's because of the stock market. Because I'm pretty sure that if we would go back to archives before the stock market, when people were talking about investing, they were talking in multiples a number of years. I'm sure they said, with this investment, you double your money in 8 years. I'm sure this is how they were thinking about it. And it's only because of the stock market that people have got into their mind that it is all about, is it a 4% or 6% investment a year, return a year? It's not possible to think that way. I cannot calculate a rate of return for a house. I cannot calculate a rate of return for any private equity. Not without serious assumptions. And so IR makes assumptions and they are very stupid. But we don't have an ideal alternative. That's why it sticks.
Thanks. Mathis, I think you have other questions.
Yes, maybe a last one before the Q&A. Regarding the news this time, we know that the Cour de Cassation is trying to impose higher taxes on carried interest. I've read that you talk about the lack of regulation and taxes in the industry. What is your guess about this new law? How PE funds will react to it?
So I've always said very clearly that the taxation of carried interest as a capital gain was the biggest BS I have ever seen. Like, this is absolutely shocking. I don't care about people, how much taxes they pay, okay? Some people may say, people should pay low taxes or high taxes. I don't care. That's not my point. That's not, I have a personal opinion, but that's not, as an academic, I don't need and I shouldn't have an opinion about that. But telling people and convincing the regulators or whatever, or the governments, that carried interest is a capital gain is BS to the power 10. Like, this is absolutely incredible. Basically, a carried interest is a bonus for having performed in a certain way. And a bonus, if you're working in a company and you get a bonus, you pay income taxes on it. So you can debate that, it should be the same tax rate for income taxes or for capital gain taxes. You can negotiate, you can tell me that you think all the taxes should be at 10%. I won't have anything to say against that. But to tell me that if you have a bonus for good performance in a company, you would pay income tax rates on this, i.e. 45, 50%. But if you are in private equity, you structure it the way they do, and then magically it becomes a capital gain, and they should be taxed at 15% to 20%, depending on countries. It's absolutely outrageous. So I'm happy to go into the details of why it isn't a capital gain. It is totally a bonus for performance. And how the industry is managing to play on words and to phrase things in a certain way, structure things in a certain way to say, oh, I did put money into that business and I just happened to receive this. And that's related to the money I've put into the company. So I should be taxed 15%. It really is to the same extent as if I'm receiving a fixed salary from Side Business School. And every year, which I actually do, I would make a donation to the school. I would say I put 10,000 onto the school, into the executive education arm of the school. And at the end of the year, as a function of how much profit there has been in executive education, I would receive something like $1 million a year. And I would say, see, this is a capital gain because I gave 10,000 into executive education at the beginning of the year, and now I'm receiving 1 million. So that's a capital gain. And be like, no, you put 10,000, your 10,000 were not at, your 10,000 are not what converted into 1 million. Your 10,000 were at rest, but not for the 1 million. And so that cannot be a capital gain. So it's a tricky issue. It would take me a fair half an hour to show exactly why and things are phrased the way they are phrased and why it led the tax offices to think and treat it as a capital gain. Because obviously, if it hasn't been lasting for 30 years in all the countries in the world, etc., is that the trick is pretty subtle in the way they phrase it and so on. They are clever, private equity guys, okay? So they know how to phrase things. But this is purely bullshit. It's absolutely incredible. And again, I could do that myself. I could very well tell Side Business School, you pay me only $50,000 a year as a salary. I put 10,000 of my own money out of this 50,000 into executive education. and then I get a share of the profits of EDHEC. And so in some years, you may get to 1 million, some years 2 million, and that will be a capital gain. I could totally structure it that way, my pay package. But I would get into trouble if I was doing that. Private equity get away with it. And it's exactly structured the way I described. So it's totally unfair. So that's one thing about their taxation. And then the question you ask is, what would happen if we tax them properly, i.e. at income tax levels? Well, they're just going to live somewhere else. They're just going to go and live somewhere else. Doesn't change anything. They will live in Monaco, in Andorra. It's a perfectly nice place to live in. It's fine. So the rent is a bit higher. And for some of these places, it's a bit more boring than to live in Paris or London. But, you know, when they go into Switzerland, at least they can cycle and ski. Although in Andorra as well, I'm a big fan of Andorra.
So they charge high fees and then they pay less on taxes on that side. And what do we expect on Econ 101? You know, that there's a lot of entry into this market, right? But are there a lot of barriers?
You want to witness entry? You want to witness desire to entry? I can invite you to my MBA students at Oxford, and you should do raise of hand. All of you wants a career in finance. How many of you wants to work for a hedge fund? You may get one hand up, okay, if you're lucky. Or how many of you wants to work on ETFs and factor investing and all these things you guys love at EDHEC? Maybe you'll get one hand up, I'm not even sure. Ask them how many of them wants to do trading of bonds and derivatives and so on. You won't get a hand up. Ask them how many of them wants to work in private equity, and everybody is not only one hand up, they probably raise both hands and their feet and tell you this is where we want to go. So you want to see desire to entry? That's no problem. I can show you desire to entry. Now, and you do, and I have like 10 teams of students a year who try to raise their own funds. Okay, like there is no problem to convert from the desire to like going on the road to raise money. There's no problem with that. The issue is that because private equity is such a wild deal for the investors, but the only thing that investors can do is like, look, I need to invest with like IBM because I won't get fired for investing in IBM. But if Emmanuel raises a fund tomorrow and I invest with him, when you invest in private equity, you give the keys of your car and of your house to a private equity guy. Okay, you just have to pray that this is going to be fine and they're not going to crash your car and destroy your house. Okay, you just give your keys and that's it. Okay, they can do anything they want. So it's a lot about trust. So if it's a big name and somebody who has done a lot of that in the past, then you're cool about it. But if Emmanuel is raising a fund tomorrow, you know, it's going to be tough. Because like, you know, it's hard to trust Emmanuel. He has no experience in private equity. So desire to entry, plenty of people. People trying to raise funds, tons of them. People managing to raise a fund, that's another story. But that's because of the structure of private equity, because like you have no control, you have no regulation to protect you as an investor, nothing. So all you have is a name, you invest in a name. And the name is unique, right? It's just, you know, there's no entry, it's a bit like schools, right? You could say, imagine that business schools will make money, which they don't. Imagine they do. And you say, well, there is no new entry. There are plenty of entries, but the ranking is what it is. So if there is like only top 10 business schools that make money because everybody wants to have a degree from these schools, you can have as many entries as you want. Like, you know, it's the name. So in private equity is the name. So that's why.
Is there a capacity issue for private equity funds? Because this is what you're saying. That means you have the big names, but the bigger they are in terms of performance.
Yeah, they are growing pretty fast. I mean, Blackstone by now is $500 billion. So one could say, okay, well, so if you go by your name and then Blackstone should, it's very interesting, your reasoning. It's very good thinking. So you would say, okay, so if only the names matter, so you have only 20 firms people want to invest into, let's say, then these firms should like grow exponentially. But I think they do. Right? So you can say, well, why don't they grow even faster? Well, they're already like, it's pretty punchy. So of course, you know, you need to add teams and so on, but they're doing that. Could they do it faster? Yeah, but there is business risk at growing too fast as well. So they are growing at a fairly intense pace. Look at Partners Group in Switzerland. Like these guys are growing at the speed of light. Ardian in Paris, speed of light. It's pretty hard to think like, okay, you could go even faster. Really? So I think max.
Have you thought of raising money, Ludo?
Yeah, but so for full transparency, there's a nice case study. So I was having a conversation once with like a senior guy at McKinsey, and he was asking me about what McKinsey should do. What would I do if I was running McKinsey? And I said, well, what you should do, and in spirit of all my research and the like, is like you should kill the intermediaries, because basically private equity firms are getting the money from the pension funds, and then they hire you to fix the companies, and they are pocketing like all these fees. You should go to the companies directly, and you should raise the money from the pension funds to take control of these companies, and you do the job. You don't need all these guys to like be in between you and the pension fund. Just go to pension funds directly, raise money, get companies with the pension funds money, you fix them, and you avoid all these layers of fees, and you contract directly with the pension fund. That's what you should do. This is what I would do as a CEO of McKinsey. And the guy was like, shit, this is good. This is a very good idea. So when the guy decided, he took all his team out of McKinsey, and they were like 30 years McKinsey people. So like seriously, like well-off people, right? They had a very comfortable life. They could have spent another 10 at McKinsey. So they came out of McKinsey and they started their own fund. And they started, like I told them, I said, like, go directly to some big asset owners and say to them that you want to be their direct private equity investing arms, and you will do the sorts of things you are doing in McKinsey. So if you're like you are specializing in tech at McKinsey, you go to these family offices and you say, you give me the money, I will do exactly what I do at McKinsey. I will get companies for you, and you will be my only like two investors. So you have full transparency on me. I'm like your employee, outsourced, and I. So they got in like no time. This guy gave a couple of phone calls. He got two families giving $500 million each. So he raised like $1 billion in like 5 phone calls, like exactly telling him what my line was. So then he called me and he said, like, maybe you should be involved with our company. It's like we are actually starting it. So I'll be a bit involved with them, but you know, there's just so many things I can do, and I'm not purely maximizing wealth. So then so I'll be involved. I'm interested in that. I think that's the right thing to do. But me raising money and investing in companies and so on, that's not my job. But you know, I'm an actor. I'm a speaker.
Since you are involved in there, what are you gonna report instead of IRR?
Well, since they work with these families. Yeah, but they work with these families directly. They get these businesses and then say, okay, this is how much money you invested. This is how much we return to you. You don't need to do any trick. They're not going to do any credit line in order to pump up an IR or anything like that. They, you know, if you have only a few investments like they do here, 10 investments, these families will very well see how much money was put in by them, how much money was taken out, and then what is the value of the current investments. Just 10 investments. These families were involved with the decision of investing in these things. Sometimes the family helps you with the sourcing, etc. So it's like you don't have any, you know, trick to play them or whatever, you know. And in terms of fees, they are your shareholder, so you have no conflicts of interest. They own you. So then, you know, whatever, you're not going to charge hidden fees or whatever. They own your company. So you're effectively their employees.
Fair enough.
On my side, there is something I wanted to discuss, Ludo, with going back to the application of having a liquid kind of mimicking portfolio for private equity. There is something, I guess, which is also important for investors, is that when you're investing in something which is illiquid, prices are not moving, so you don't see volatility.
Yeah, no, you will not have his benefits. You will not have his benefits. But I always tell people, if what you're after is a smooth NAV, and you invest in private equity because it's going to be smooth, and you cannot, you know, you cannot take the movement of the NAVs. I have a much better investment than that for you, Emmanuel. Is that instead of giving your money to a KKR who's going to like indeed smooth the NAV, but it's going to move, okay? Instead of that, just buy yourself a few buildings in Nice, buy yourself like some farms, buy yourself some vineyards, buy yourself whatever you want, And you know what? You will be able to decide exactly how much these things are valued and how much you want to smooth them, like you. And then you can say, oh, but it needs to be audited. You will hire an auditor and you say, you know, I hire you, Amit, as an auditor. But so, you know, I like things to be very smooth. And if you're not going to smooth it high enough, next year I hire Matisse as an auditor. I'm told he's smoothing things even better.
Yeah,
right?
but
so you don't need to pay all these fees to have something smooth. Okay, just buy yourself a few things and you come up with your own valuations.
I agreed, but it's interesting. So what you're saying is basically, because it's always trying to understand the motivation of the asset owners, which are going in private equity, right? And
yeah,
and what
so these family offices don't care about smooth NAVs, their own money. Okay, like the money of the family. So like, I don't care that you smooth my, you know, you're working on my blood pressure or something. So maybe, but that, right? So the people who care about smoothing is people who have to fool someone. So the primary people is usually the pension funds. They need to fool the regulator, right? That they didn't get like funding issues, and so they are very keen on that. And university endowments, because they want to tell the university not to take too much money out or to leave them alone when it's not going well. So which is an interesting problem, by the way, this year, because venture capital has done so well that university endowments are on paper up like 50% or something like that. So the universities want 4% of the value of the endowment. So they want 4% of this huge increase. And then the university endowments have to explain that it's actually paper money and it's not like really real. And so it shouldn't like take 4% of that stuff. So yeah, you do have interesting issues around NAV smoothness. So yeah, you need to understand the motivations of people. But again, if someone tells me I invest in private equity because I like smooth NAVs, I have better options.
Okay, so super. I don't know, Hamid or Matisse, if you want to add final questions to Ludo before we finish the talk. We can talk for I don't know how many hours, but Ludo got also.
Yeah,
I have a tapas evening to go to.
Oh, great.
I have maybe, yeah, we don't have much time. Maybe the last question and a bit of advertising for EDHEC. We are one of the leading business schools, you know, focusing and going toward the addressing the climate change and, you know, social responsibility of business and all those kind of topics. And now we are talking about private equity. So I wonder what is your thoughts are on how much of the problem is going to be solved by them or how much they are going to create problem for this.
And perhaps a related question I wanted to ask too is you have this sustainable, you know, SFDR new regulation, which have been enacted by Europe. And I guess private equity funds also have to report on ESG. So it's related to what Amit said. That means you have this momentum, there is disclosure.
Just before this lecture, I spent an hour with an impact investor doing a lecture on ESG and private markets. I have a talk on YouTube. You can find everything on my website. So on YouTube, there is a talk on ESG and my key takeaway from ESG. It's also in my book about the importance of additionality, the issue that when you intervene on secondary markets, you cannot have any impact. So private equity, a lot of it is secondary markets. So like leverage buyouts and so on are typically not injections of cash in companies. So that has very little potential for impact, although you control companies. So you could this way. But the part of a private equity, which is like growth and venture capital, where they inject equity into companies and control companies, there is a huge potential for impact. Now, whether they use it for the right things or not, then that will depend a bit on the funds and everything. I'm not that pleased to where they are on ESG and impact. Again, you can like listen to my talk because I have a very minority view so on this one too. So it takes me a while to develop that. But let's say in a nutshell, 99% of what we see is greenwashing, and saying that the European Union is asking them to report on ESG is basically asking them for an essay about why they are good people. And they say, oh, I created jobs and I hired some minorities and I I enable people to send their children to school because I pay them a salary actually against their work. And in terms of environment, I changed the air conditioning into my factories. And so I'm spending less on electricity, which is a good thing. And we're trying to keep the heating not higher than 20 degrees and blah, blah, blah. And like, it's like whatever, right? So you just, it's just an exercise in PR and writing something about like, you know, when you write a statement for your research, like, you know, you just write stuff, but like writing stuff doesn't solve any problem.
I think this is clear. So thank you very much, Amit. Thank you, Mathis, and most importantly, thank you very much, Ludo. Merci beaucoup. I owe you a good bottle when you come to visit us to Nice. You're welcome. You know that. And before we finish, just to mention that the next session will be next Thursday, and we will talk about another topic with Campbell Harvey from Duke University. We'll talk about decentralized finance. So thank you, Ludo. Merci beaucoup.
Yep.
See you soon. Bye-bye. Thank you, Amit.
Bye-bye.
Thank you, Mathis. Merci
Bye-bye.
beaucoup.
Yep.
See you.